Welcome to Breaking News to Trading Moves. Today we're looking at what happens when the mechanics of the market force money to move, not because of a company's performance, but because of a simple rule change.
Exactly. We're zeroing in on a very specific kind of capital flow. It's mandatory, it's predictable, and it's all driven by how major stock indices are constructed.
And the headline driving this whole conversation is a change in one of the most watched indices out there, the Nasdaq-100.
That's right.
So let's get right to it. The core news is that Walmart, ticker WMT, is being added to the Nasdaq-100 index.
Correct. And, for every addition, there has to be a subtraction. Walmart is getting in, and AstraZeneca, ticker AEZN, is the company being removed.
Okay, so a simple swap. But for the funds that are designed to just copy the Nasdaq-100, this is a lot more than just a memo.
It's a direct order.
Yeah.
And what makes it so important for traders and observers is that there's a hard deadline attached.
And that deadline is the critical piece of the puzzle.
It absolutely is. The change becomes effective before the market opens on January 20, 2026.
January 20, 2026.
Yep. So that date creates a very specific window. In the days and really the hours leading up to it, billions of dollars have to move out of AZN and into WMT. And it has to happen regardless of what you or I think about either company's business prospects on that day.
So that calendar date gives us a clear runway to watch this whole thing unfold. We can see the positioning, we can anticipate the volume. It's all laid out.
All laid out.
So let's start with a really basic question, because if you're not deep in market structure, this might not seem like a big deal. I mean, we're talking about Walmart and AstraZeneca. These are enormous companies.
It's giants.
Right. So why does a simple administrative tweak to an index get so much attention? Why doesn't the market just, absorb this change smoothly?
Well, it comes down to the sheer weight of the money that's forced to act. We're talking about passive index funds and ETFs. And the amount of capital in these vehicles is, it's staggering. Trillions of dollars globally.
And their one and only job is to perfectly mirror whatever the Nasdaq-100 does.
That's their entire reason for being. There are no star stock pickers making judgment calls. Their mandate, in their legal prospectus, is to follow the index recipe to the letter.
So when the recipe changes, they have to change.
They absolutely have to. When Nasdaq says swap AZN for WMT, every single one of those tracker funds is obligated to do exactly that. They can't say, we think AZN looks cheap right now, we'll wait.
There's no waiting.
No waiting. It is a mandatory adjustment.
And this obligation, it forces them to trade without really caring about the price, only the timing. But if everyone knows this is coming, why don't traders just get in front of it and sort of cancel out the whole effect?
That's where a very important concept comes in. It's called tracking error.
Okay.
The number one priority for these fund managers is not to make a profit on this specific trade. Their priority is to minimize the difference between their fund's performance and the index's performance. That difference is the tracking error.
So if they buy Walmart at a much higher price than the official index price, they've failed.
They've failed. If the fund buys WMT at an average of, say, $140, but the index officially marks the rebalance price at $138, well, that $2 difference is tracking error. It's underperformance. It's a huge problem for them.
So their biggest fear is buying the new stock too high or selling the old stock too low compared to that official closing price.
Precisely. And because of that, it forces a huge amount of trading volume into a very specific time and place. It's called the closing auction.
The last few minutes of the trading day.
Exactly. The closing auction is a process the exchange runs to match all the final buy and sell orders at a single price point for the day. For these index funds, it's the perfect solution.
Why is that?
Because if they execute their big trades during that closing auction on the last day, they are almost guaranteed to get a price that aligns perfectly with the index's official calculation price.
So it minimizes that tracking error risk we were just talking about.
It all but eliminates it. And that's why we see this massive concentration of activity right at the end of the day before the change happens.
So in practice, what does this look like for the funds?
It's a giant two-sided trade. They have to put in huge buy orders for Walmart, WMT, and at the same time, they're selling their entire position in AstraZeneca, AZN.
We're talking about billions of dollars in mandatory buys for WMT and billions in mandatory sells for AZN, all happening in a really tight window. That has to affect the price.
Oh, it does. It creates a very predictable, flow-driven price pressure. You'll see it start to build in the days leading up to the change. But the real The real fireworks, the non-discretionary volume, that all happens in the closing auction just before the effective date.
And it's also worth noting, this isn't just about the main Nasdaq 100 index, is it? Walmart is also being added to other related indices.
Yes, and that's a key point. It's an amplification effect. You have leveraged ETFs. You have other sort of specialized versions of the index.
And they all have to do the same thing.
Every single one. They all have the same mandate. So that just adds to the total amount of money that has to buy Walmart, and of course adds to the total amount of money that has to sell AstraZeneca. It just makes the flows even bigger.
So, just to be crystal clear, AstraZeneca being removed, this has nothing to do with their latest drug trial or their earnings forecast.
Nothing at all. This is purely administrative. It's based on the index's internal rules, maybe about market cap, maybe about where the stock is listed. The market is reacting to a rule, not to a change in the company's value.
And that distinction is everything.
It's the whole game, the flow versus the fundamentals. That's where the opportunity is.
Let's talk a little more about how the funds actually do this. They can't just show up at 3:55 p.m. on the final day and place a $10 billion order, can they?
No, that would be, well, that'd be reckless.
Yeah.
They try to be more subtle. For the buy side, for WMT, they'll use what's called an accumulation strategy.
Meaning they buy a little bit at a time.
Exactly. Over the weeks before the deadline, they'll use algorithms and brokers to quietly buy up shares in small chunks, trying not to alert the market to what they're doing.
And the same for selling as a yen.
The mirror image, a distribution strategy. They'll slowly leak shares into the market. They're trying their best to hide their hand.
Because if the market knows a huge price-insensitive seller is out there, the price will drop ahead of them.
Precisely. That would create that trading error they're so desperate to avoid. But, and this is the important part, they can only hide so much. There's always a final massive chunk that they can't place discreetly.
And that's the piece that has to go into the closing auction.
Yes, the part that hits the closing auction. That's the non-discretionary must-trade amount.
So for WMT on, what would it be, January 19th, 2026, we should probably expect to see a volume spike in the last few minutes of trading that could be bigger than the volume for the entire rest of the day.
That is the classic pattern you see in these events. The volume at the close can be absolutely enormous. And this predictability is what creates a really nice setup for the firms that specialize in providing liquidity.
The market makers.
The market makers and the execution brokers. The whole ecosystem is built to handle these predictable moments of concentrated flow.
Okay, this is a great foundation. Let's start to look at the specific companies that come out ahead here. We can separate them into a few groups based on why they benefit.
Sounds good. We can start with the most direct beneficiary and then look at the second-order effects.
Perfect. So the primary name has to be Walmart, WMT.
Without a doubt. The demand here is purely mechanical. It's not a guess, it's a certainty. Every single fund that tracks the Nasdaq 100 has to buy Walmart shares.
And not just the passive funds, right?
Good point. It's also the benchmark-aware managers. These are the active funds. But their performance is judged against the Nasdaq 100. So if they don't own Walmart, they're taking a massive bet against the index.
And if WMT goes up, their fund automatically underperforms. That's career risk for a fund manager.
Huge career risk. So what you get is this guaranteed concentrated demand for WMT shares. And historically, we see stocks that are added to big indices get a little price bump leading up to the effective date. It's often called the inclusion pop.
An inclusion pop driven by this guaranteed demand.
Exactly. It's a clear tailwind for the stock in that specific window of time.
Now, the analysis also brings up Amazon, AMZN. Amazon isn't being added or removed, so why is it listed as a beneficiary?
Yeah, this is a bit more nuanced. It's about portfolio management and sector context. With Walmart joining, the mega retail segment of the Nasdaq 100 gets a lot bigger and more prominent.
And Amazon is the other titan in that space.
The other titan. So when billions of dollars are being forced into WMT, it makes every active manager take a hard look at their retail holdings. They have to reevaluate the whole sector.
So they might look at the relative value. Is Amazon now cheap compared to an index-inflated Walmart?
That's one angle. They might rotate from one to the other. Or they might simply decide, okay, this segment of the index is now more heavily weighted, so we need to increase our overall exposure. And they might buy more AMZN to accomplish that.
So for Amazon, it's not a mandatory flow. It's more of a ripple effect from portfolio managers reacting to the change.
That's a perfect way to put it. It's a strategic reaction, not a mandatory action.
Okay, let's move on to the exchange itself. This has to be seen as a good thing for Nasdaq, the company.
Oh, absolutely. The stock exchange business is incredibly competitive. Getting a huge globally recognized company like Walmart into your main index is a major prestige win.
It's bragging rights.
It's bragging rights, but it's also more than that. It reinforces the brand. It drives interest in all of their products.
What kinds of products?
Well, data, for one. The more prestigious your index is, the more firms want to license the data associated with it. It also helps them attract other new company listings. It builds momentum.
So the stock of the exchange operator, Nasdaq, which trades under NDAQ, should benefit from this positive story.
Yes, the narrative helps. It suggests they're winning against their rivals, and that can provide a nice short-term lift for NDAQ's own stock price.
The analysis also mentions MSCI. Now, MSCI is a huge index provider, but they don't run the Nasdaq exchange. So what's their connection?
MSCI benefits from you could say, the rising tide. Their entire business is creating and licensing indices and financial data. Anytime you have a high-profile event like this, it puts a spotlight on the entire index industry.
It reminds people how important these indices are.
Exactly. It reinforces the trend of passive investing and the importance of benchmarks. More activity in index tracking ultimately means more business for the big players in that space, and MSCI is one of the biggest.
So it's an industry-wide tailwind.
You could call it that, yes. An ambient lift for the whole ecosystem.
Okay, so let's get down to the folks in the trenches, the firms that actually make these trades happen. This has to be a great day for them.
It is. When you have a guaranteed massive amount of trading that has to happen in a very short period of time, well, that's a golden opportunity for certain types of firms.
And the analysis points to two specifically: Virtu Financial, VIRT, and Cowen, COWN. Let's start with Virtu. What's their role?
VIRT is a classic market maker. Their business is all about volume and providing liquidity. When those index funds show up needing to buy billions of dollars of WMT at the close, they need someone on the other side of that trade ready to sell.
And that's Virtu.
That's VIRT. They step in and provide that instant liquidity. They take on the risk for a fraction of a second, and they get paid for it through the bid-ask spread.
The small difference between the buying and selling price.
Correct. And on a day with massive one-sided flow like this, they can often widen that spread just a tiny bit, which makes the trade even more profitable for them. The huge volume is just a direct boost to their bottom line.
And what about Cowen, COWN? How are they different?
Cowen is more on the institutional brokerage side. They act as the agent for the big funds. An index fund doesn't just log into a retail account and hit buy. For a trade this big, they hire a firm like Cowen to manage the execution.
So Cowen is the one running that accumulation strategy we talked about earlier?
Yes, they're the specialists. They work to get the best possible price for their client, the index fund, without moving the market too much. They're experts in handling these huge, complex block trades.
And they get paid commissions for doing that.
Commissions and fees. So a guaranteed complex rebalance like this one means guaranteed business for a firm like Cowen.
So if we look at all the winners, it's a whole chain. You have the stock being added, WMT, its main competitor, AMZN, the exchange brand, NDAQ, and the index industry like MSCI, and then the trading firms that handle the flow like VIRT and COWN.
That's right. It shows how a single administrative decision can create benefits across a whole network of related companies. It's a reminder that, in the short run, market plumbing can be more powerful than anything else.
Okay, now, let's flip the coin and look at the other side, the companies that are facing pressure from this same event.
Right. For every winner created by mandatory buying, there's pressure on the other side from mandatory selling.
And the name at the top of that list has to be AstraZeneca, AZN.
That's the epicenter of the selling pressure. As we said, every single NASDAQ 100 tracker fund is required to sell their entire holding of AZN.
There's no way around it.
No way around it. It's guaranteed for selling. And that creates a predictable supply overhang for AZN shares in the days leading up to January 20th. For some traders, that's a clear short signal. For others, it might be a chance to buy the stock at a discount once the forced selling is over.
But the analysis also includes Gilead Dynasys, GILD. Gilead isn't being removed, so why would it face pressure?
This gets into the more sophisticated side of portfolio management. GILD is in the same boat as AstraZeneca, a major pharmaceutical and healthcare company.
A direct peer.
A direct peer. So when these big funds are forced to sell a large healthcare position like AZN, the active managers, the benchmark-aware ones, often use it as a trigger to reevaluate their entire exposure to that sector.
So the removal of AZN actually lowers the total weight of the pharmaceutical sector in the index.
Precisely. And an active manager might look at their portfolio and say, okay, with AZN gone, we are now overweight healthcare relative to the new index. We need to trim some of our other healthcare names to get back in line.
And a name like Gilead would be a prime candidate for that trimming.
A prime candidate. So this isn't mandatory selling from passive funds, but it's strategic selling from active funds who are trying to manage their risk relative to the new benchmark. It's a spillover effect.
Right, the strategic adjustment. Now let's go back to the exchange competition angle. If this is a win for Nasdaq, it must be perceived as a bit of a negative for its rivals.
It is. It's all about the market structure narrative. The exchange business is a constant battle for prestige and listings. When Nasdaq lands a big fish, it can create a short-term narrative pressure on its competitors.
And the two big competitors listed are Intercontinental Exchange, ICE, and Cboe Global Markets, CBOE.
That's right. ICE, of course, operates the New York Stock Exchange, the NYSE,
Nasdaq's main rival.
their oldest and biggest rival for company listings. When a company of Walmart's stature gets added to Nasdaq's flagship index, it's a direct challenge to the NYSE's own prestige. So the narrative can weigh a little bit on ICE's stock.
And what about Cboe, CBOE?
Cboe is a little different. They are more focused on options and futures, though they do compete in indices with products like the VIX. For them, the pressure is more about the perception and momentum in the industry.
So if Nasdaq is seen as gaining ground and strengthening its index franchise,
It can cast a bit of a shadow on the growth prospects of its competitors. It's not about a direct loss of business today, but more about the market pricing in a tougher competitive environment tomorrow.
it's all based on perception, not on actual flows.
Exactly. It's a narrative headwind, not a mechanical one.
Okay, let's look at one more category of pressured names. The analysis mentions sector rotation and how it can affect other big pharma companies, even beyond Gilead.
Yes, this is about how active traders try to play these events. They see the predictable, forced selling of AZN, and they try to get ahead of it or hedge against it.
So they might short AstraZeneca, but they might also short other similar companies at the same time.
They might. The thinking is that a huge, forced sale of a major healthcare stock like AZN could temporarily drag down sentiment for the entire sector. So to protect themselves or to make a speculative bet, they might short a basket of pharma stocks.
They're betting on the market's collective reaction to the big sell order.
That's it. If the index is reducing its overall exposure to healthcare, sophisticated traders will do the same thing preemptively.
And the analysis specifically calls out Pfizer, PFE, and Merck, MRK.
Right. PFE and MRK are two other giants in the space. They're widely held by the exact same institutions that are being forced to sell AZN.
I see.
So as the AZN liquidation hits the market, it just injects this huge supply of healthcare stock, which can increase volatility for all the big names. An active manager might sell a few shares of PFE or MRK just to manage their risk and stay aligned with the new, smaller healthcare weighting in the index.
Which means that if you see PFE or MRK dip a little around that January date, it might have absolutely nothing to do with their business.
It could be pure collateral damage from the forced sale of AstraZeneca. It's a perfect example of how, for a short time, market mechanics can completely overwhelm company fundamentals.
That really illustrates how interconnected all of this is. An administrative rule for one company can have effects across its entire peer group.
It's a powerful force.
All right, we've covered a lot of ground. Let's try to distill this into a few practical takeaways for someone watching this event play out. What are the key things to monitor?
Okay, I think we can boil it down to 3 main points. The first one is the most simple.
Which is,
Watch the calendar.
the date is everything.
It's the foundation for everything. The effective date is before the market opened on January 20, 2026. That is the hard deadline.
But the real action happens before that, right? We should be looking at the days leading up to it.
Yes, specifically the 3 to 5 trading days right before that date. That's when you'll start to see the bigger funds making their final positioning moves. The quiet accumulation of WMT and the distribution of AZN.
And then the grand finale is that Friday afternoon, January 17th.
If the 20th is a Monday, then yes, the closing auction on Friday the 17th is the critical moment. That's where the final, mandatory, can't-be-avoided trades will happen. That's where you'll see the most intense volume and volatility.
Okay, so number 1 is watch the calendar. What's the second point?
The second is to understand the common relative trade. This is the most direct strategy traders use for these events.
A pair trade.
A pair trade. They go long the stock being added, so they buy Walmart, WM&T. And at the same time, they go short the stock being removed, so they sell AstraZeneca, AZN.
And the idea there is to isolate the effect of the index rebalance.
That's the goal. You're trying to be neutral to the overall market. If the whole market goes up or down, your long and short positions should roughly cancel each other out. What you're left with is a pure bet on the buying pressure in WMT versus the selling pressure in AZN.
It seems like a pretty straightforward trade based on a guaranteed flow, but there has to be a catch. What's the main risk here?
The main risk is timing your exit. This is a very temporary effect. That inclusion pop for WMT, it often disappears very quickly once the rebalance is done.
Because the artificial demand is suddenly gone.
It's gone. The mandatory buyers have finished their work, and the stock immediately goes back to trading on its own fundamentals. So the trade only works if you get in while the pressure is building, and critically, you get out right after the rebalance is complete.
If you hold on for too long, a winning trade can quickly turn into a loser.
Very quickly. You have to be disciplined. This is a trade on a short-term market mechanic, not a long-term investment.
All right, so watch the calendar, understand the pair trade. What's the third and final point?
The third point is to look for confirmation signals in the market data. How can you tell in real time that the big money is actually moving?
Okay, what are those signals?
There are three main ones. The first, and the most obvious, is volume.
Makes sense.
You want to look for unusual volume in the closing auction for both WMT and AZN, especially on that final trading day. If you see volume that's 4, 5, 10 times the normal amount, that's your confirmation. That's the index funds doing their work.
So number one is volume. What's the second signal?
The second is to watch the bid-ask spreads.
The gap between the buy and sell price.
Right. When this huge one-sided flow hits the market,
Yeah.
it puts a strain on liquidity. The market makers who have to absorb all those orders, they'll widen their spreads to compensate themselves for the increased risk. So if you see spreads on WMT and AZN getting wider than usual near the close, that's another sign the system is feeling the pressure of the rebalance.
So volume and spreads. And the third signal?
The third is a bit more advanced, but it's very telling. It's the options skew.
Can you explain that?
Sure. The skew basically tells you if the options market is betting on a bigger move up or a bigger move down. It's about the relative price of call options versus put options.
Okay.
As the rebalance date gets closer, the market starts to price in the certainty of these flows. For WMT, everyone knows there's guaranteed buying pressure. So call options, which are bets on the price going up, become relatively more expensive than put options.
And for AstraZeneca, it's the opposite.
The exact opposite. The guaranteed selling pressure makes put options, which protect against a price drop, much more expensive relative to calls. So watching how that skew changes for both stocks can give you a real-time read on how the market is anticipating the event.
So those three signals, volume, spreads, and options skew, can help confirm that what you expect to happen is actually happening.
They're your dashboard. They provide a real-time check on the rebalance pressure.
This has been a really thorough look at this. It's a great example of how these index changes work.
Well, what's really telling about these rebalances is just how reliably they can dictate price moves in the short term. And it has nothing to do with the actual businesses. It's all about the plumbing of the financial system.
It's the rules of the game creating the price action, not Walmart's sales numbers or AstraZeneca's drug pipeline.
Precisely. And, a final thought for you to consider. It goes back to those other pharma stocks, Pfizer and Merck.
The ones that felt the spillover pressure.
Right. We know the selling in PFE and MRK was tactical, not mandatory like it was for AZN. So here's something to watch. After January 20th, track the performance of all three. See if Pfizer and Merck bounce back faster than AstraZeneca does.
And if they do.
If they do, it's a very clear sign that the temporary price drop in those stocks was nothing more than flow-driven noise. It's a great way to see, with your own eyes, the difference between a real change in a company's value and a temporary dislocation caused by market mechanics.
That's a great real-world test to watch for. Thank you for walking us through all of this.
My pleasure. It's always great to get into how the system really works.
Disclaimer. This discussion is not financial advice or buy or sell recommendations. This analysis is purely the opinion of the author.